Welcome to Strategy Saturday. I'm Charles Crillo, and today we're going to be discussing how do you reduce your real estate debt with inflation. And it's a little bit more of an advanced topic, but I want to explain how inflation, along with fixed-term debt and real estate, can really be to the benefit of the real estate investor. So inflation has definitely picked up here in 2021, while interest rates have been hovering around historic lows. During the first half of 2021, the CPI, Consumer Price Index, was increasing at about 0.5% each month, or 5.4% over the past 12 months. It is widely believed by many economists that the CPI is understated, which I agree with fully. I feel the true inflation is most likely nearly twice or at least 50% higher. Just review what you spent for rent, groceries, insurance, gas today versus 6 to 12 months ago. You're definitely going to see an increase. The government is creating lots of debt, and families are taking on a lot of debt as well. And average family has about $16,000 in credit card debt, $175,000 in mortgages, almost $30,000 in auto loans, and nearly $50,000 in student loans. In all, the government now needs to spend a lot more money to keep everything going, all resulting in more inflation. The government and the American public on average are all going to get into more debt in 2021 and into 2022. The Federal Reserve said in 2020 that inflation will be above 2% for some time, admitting to the fact that inflation will start ticking up, which we have definitely seen over the last 12 to 18 months. Now, inflation was defined to me years back as you live on an island and there are 1,000 coconuts, and then there are 1,000 $1 bills. And an airplane comes by and drops another 1,000 $1 bills on the island, and now you have $2,000 chasing the 1,000 coconuts. Now, what happens to the price of those coconuts? Well, that is what's happening today. Shortages and price increases since too many dollars are chasing too few resources. The government can't just go and print apartment buildings. They can't go and print lumber. They can just print money. Now, inflation steals away your savings and erodes your debt, but eroding your debt and the government debt at the same time. That's very important. There's taxing, the American public, we always hear about taxes, and people want lower taxes and some people want higher taxes. But the tax that no one really talks about is the inflation tax. And the inflation tax hurts middle and lower income individuals because their money is not working at inflation or above inflation, and their wages aren't increasing at the rate of inflation. So they become the real losers. The real losers are savers, retirees, and workers on fixed incomes, borrowers with variable debt, because as inflation goes up, the debt will go up, right? The rate will go up. The winners are debtors with fixed debt and government with high debts and owners of physical assets. Because if you can mix all that together and you're an owner of a physical asset, and you can, that's why we love the one-year leases on properties, because we can keep on adjusting our rent to hold up with inflation. It's very difficult for people that have long-term leases, unless they've worked something into there, to be able to adjust their rent with inflation. So it's something to keep in mind. Now, the other thing too is with the governments with high debt, as inflation happens, it erodes their debt as well, which is the main reason of how we've really been paying for all this debt we've been printing. It's not really going to get paid by anybody because you only tax people so much. But the thing, though, is that we're paying for it with inflation. And who's really paying for it? Well, it's a lower and middle class. Now, just to clarify, I'm not suggesting people go out and purchase depreciating assets with cheap debt. I am, however, suggesting that people purchase real estate or refinance real estate with fixed long-term debt, and that's the key. So how can real estate investors erode their debt with inflation? Well, if you find an asset that cash flows, say, leverage them 75% of the asset, or if you're house hacking 96.5% of the asset with a FHA loan, with fixed long-term debt, you'll be able to hedge inflation. Okay, your expenses will increase, your rent will also increase, but your debt will stay fixed. So look at when you're paying this mortgage payment. Let's put all the other expenses to the side, but your mortgage payment on a house hack, let's just say everything's put together in one, and you have your mortgage, principal, interest, okay, which is the biggest portion of it, and then you're going to have insurance and taxes. Now, taxes will go with inflation, and you're going to have your insurance, which will go up with inflation. But principal and interest will be fixed, and that's going to be the largest portion of what you're paying on a monthly basis. Now, if your insurance goes up 5%, it's really not that much. If your taxes go up 5%, whatever it is, it's really not that much. You can adjust your renter's rent up 5% for that, right? Or with whatever the market's happening in your area. But the thing, though, is that principal and interest, the largest portion of your monthly payments, are not going up. Okay, they're going to stay fixed. So every month that you pay your mortgage, you're paying with dollars that are worth less than 1 month before. For example, the CPI said inflation was 0.9% in June of 2021. So the dollars you paid your mortgage with in July were worth nearly 1% less than when you paid your mortgage in June. So $100 in June had the purchasing power of $99.10 in July. When there is massive inflation, fixed debt is no longer a liability, but it becomes really an asset. And your savings becomes a liability because it's getting eroded every month. So if you're, like they've said, from July 2020 to July 2021, 5.4% has been the inflation of the CPI, which is most likely higher than that, and you were paid, let's say, 0.5% at your bank, your money lost 4.9% over that 12-month period. So it just goes to show you how your savings just erodes and becomes a liability with inflation. But the key is that real estate is your ticket to hedging inflation. It's really what you want to be focusing on and acquiring. Okay. Now, don't take my word on inflation. Do some research into inflation of the 70s and 80s. I mean, inflation was 13.3% in 1979 and 12.5% in 1980. While in 1980, the Fed funds rate, which means the interest rate at which banks and other depository institutions lend money to each other, usually on an overnight basis, was 18%. That's how high it was. Today, it's 25 basis points, right? It's 0.25%. I mean, it's crazy where we've come. But so when you're buying real estate, look for long-term fixed debt on your properties. Make sure the property cash flows, and you're going to be able to put your money in one of the safest assets that's going to be able to readjust, because you're able to readjust your income, readjust what your clients, what your tenants are paying every month, every year, so that when your expenses go up, your rents can follow right behind it. But your debt will not be increasing. So please remember to rate, review, subscribe, submit comments and potential show topics at globalinvestorspodcast.com. Look forward to 2 more episodes next week. See you then.
Nothing in this episode should be considered specific, personal, or professional advice. Any investment opportunities mentioned on this podcast are limited to accredited investors. Any investments will only be made with proper disclosure, subscription documentation, and are subject to all applicable laws. Please consult an appropriate tax, legal, real estate, financial, or business professional for individualized advice. Opinions of guests are their own. Information is not guaranteed. All investment strategies have the potential for profit or loss. The host is operating on behalf of Syndication Superstars, LLC exclusively.